Good morning, everyone. Welcome to this rundown for global stock markets. And it has been a horrid start to the first 2 weeks of 2016. One of the worst, in fact, probably the worst in history for the start of a new year. And there is a fairly good correlation between how the US market performs in January and how it performs for the rest of the year. If we end up down in January, and certainly the indications are at this stage that that's probably going to be the case, then it's generally not a good sign for the year as a whole. Now, for those of you that have been watching these videos for some time, you know that I've consistently said for the last 2 years that the fundamental precursors for a bear market are not in place. They relate to interest rates rising. They relate to a significant amount of money being in the market, and they also relate to a level of exuberance and also to valuations, and none of those things are in place. However, we are in a completely new financial world since the GFC, and therefore we shouldn't cling to those old relationships that have occurred before, because it could well be that there are other stresses in the system that have never been there before, and I can absolutely accept that could cause markets to behave in a different fashion. And certainly the start we've had to 2016 has been bad enough for everyone to be open-minded about what's going on. So let's have a look at the details. I think you'll find this video very insightful in terms of how things are likely to play out in both the near term and the longer term. So the general backdrop, just continuing on from last week, I just want to give you a fundamental basis for what we're going to look at today. So the general backdrop is that since the GFC, investors have accepted decreasing returns for products that have increasing risk, because they weren't able to get sufficient income from the traditional government bond routes and fixed interest routes. Then they've gone into other far more risky instruments, and that's fine as long as you're getting a 12 to 15% return per year. But what's happened is, because everyone's been piling into these instruments, then the yield on those instruments has come down, and in some cases people were accepting 5 and 6% for return for assets that should have been generating 12 to 15%. So higher and higher risk, less and less return, not a good formula, and eventually it has to revert to some sort of normal, and that process, I believe, has well and truly started now. So the consequences of that are becoming very evident. Now, the big question, of course, is this just another correction, or is this the start of a large and lengthy adjustment? I'm reluctant to call it to say that there could be a bear market, but this certainly could be a more substantial correction of the move that we've had since the GFC. Now, ultimately, again, people that have been watching these videos for some time will know that I've been completely upfront and said that I believe that at some point in the future there will be a big adjustment, and it will probably be worse than the GFC, because the debt is 2 to 3 times bigger than it was back then, and a lot of things have been stretched to the limit. So I believe there is some sort of cataclysmic event coming. However, I've also said that I didn't see it on the horizon for at least 2 years, possibly 5, possibly 10. Now, the events of the last few months, and in particular what the market has done in response to that in the last couple of weeks, leads me to believe that that could now be closer than what I had previously thought. I'm not saying it is. I'm not ringing the fire bell yet, but I am open-minded to the fact that we could be much closer to some sort of significant event. Now, I don't say that to frighten you, because there's plenty of people out there doing that, and you know that I've been consistently bullish and positive for the whole of the last couple of years, when a lot of people have turned negative. All I'm saying is that, given the events of the recent time, I think that it's possible that matters could deteriorate quite quickly from here. I think I'm very comfortable that we're looking at a low growth and possible and certainly very low inflation and possible deflationary period for a very long period. That should read, sorry. And I'm talking 5, 10 years, possibly a couple of decades. And the reason that I say that is that the world has too much capacity, too much manufacturing capacity to produce things. And there is also too much excess labour for what needs to be produced. And it's those things that cause inflation when there is more demand than what there is supply, than what people can manufacture. And when there aren't enough people to do the work, that's when wage pressures go up. Now, neither of those things are remotely evident, and that's largely because of massive increases in technology that's made manufacturing more efficient. So I don't see that inflation is going to be an issue at all, and I think that deflation is quite likely an issue certainly in some areas. The massive liquidity that the central banks have injected into the world system over the last 5 years hasn't caused inflation. So if that hasn't caused inflation with trillions and trillions of dollars, then I don't know what the heck is. So I think it's pretty much a given that inflation's not going to be a problem. And I think it's very likely now that the world as a whole may experience what Japan has done for the last 20 to 25 years, and that's effectively a stagnating economy. Extremely low growth, periods of recession, and basically no progress and deflation in asset prices. I hope that's not the case, but I'm starting to see that given all the issues now with Europe and with China, that we may well be going down the same path that Japan has done since the 1990s. And the reason that Japan went through that is that they failed to bring the debt to account. And that's really what's happened on a global basis, thanks to central banks. So I think that's a distinct possibility. So what sort of assets do well in a low growth, low inflation environment? Because as investors, we can't just throw our hands in the air and say, well, that's it, we can't do anything. We still have to invest and we still have to make a return. So what does well in this sort of environment? And frankly, it's no change to what I've been emphasizing. And members of specialist share education know very clearly where those opportunities lie, and in general terms, they are in areas where the growth of that sector is pretty much a given. And I'm talking about digital technology, and I'm talking about healthcare and biotechnology. Those areas are going to continue to grow very rapidly, irrespective of what the world's growth rate is doing, because there is just demand for those things. So they're the sort of sectors where the growth is going to come. However, your methods of how you make money from those sectors have got to change, because in this sort of market environment, particularly right now, fundamentals are just out the window. People are panicking, prices are plummeting to irrational levels. So you can't just say, oh, well, I'll buy a good quality asset and I'll sit on it and eventually it'll go up. Well, that might be the case, but you might have to wait a long time for that to happen. So different methodologies have to be used in this sort of environment. So, that's critical. If there's one key message from this video this week, is that your methods of how you engage with the market have got to change. Looking at American stocks, the S&P was down by 42 points for the week, and a total of 8% already this year since the 4th of January. Now, interestingly, despite the very significant falls, the VIX index is only up to 27. And I would have thought that it would have been closer to 35 or 40, given what we've seen in the last 2 weeks, because that decline has been very similar to the decline we saw in August when the VIX did spike up to 40. And so it begs the question, why are people less fearful when the market has fallen in exactly the same manner? I don't have a ready answer to that question, but I just note it as something that's not consistent with what we're seeing. Now, the August lows, I indicated last week that the August lows were probably going to be tested. They were on Friday night, and you'd be a brave person to say that they couldn't be broken. We'll look at the chart in just a minute. So markets in general are caught in a fairly negative feedback loop, and short term they're very oversold. So I wouldn't be surprised to see a bounce next week, possibly a couple of weeks. And it's the nature of that bounce that will tell us a great deal about how things are going to unfold this year. If the bounce is strong, then it's quite possible that we could head back to the top of the trading range. Frankly, I'm doubtful about that, given what I've seen in the last few weeks. If the bounce is really weak and only goes for a few days, then that's telling us very, very clearly about what's likely to be coming. Now, whether we're going into a bear market or not, and there's plenty of people out there will tell you that we are, that's just wishful thinking on their part because that's their view of the world. But whether we're in a bear market or not, the character of the market has changed. I think that's quite clear when you see the chart. So let's look at the S&P index now. So I want to start first of all with the monthly chart. So we're looking at a very big picture here. Left-hand side of the screen is 1998. So we're looking at about 18 years, nearly 2 decades of S&P trading history. You'll see the two twin peaks of 2000, the crash in 2000, the crash in 2008. They were basically from the same level. And this current bull run from 2009 has gone way beyond that. Now, I've had this blue line, this blue 12-month moving average line on this chart. I'll just get rid of these. Bollinger Bands, just tidy it up a little bit. So you can see that this blue 12-month moving average line has been a pretty good indicator of major turns in the market. And I wrote that comment probably 6 or 8 months ago. Watch for a close below the 12-month moving average or the trend line. I'll just extend that trend line up there a bit. So I would have written that back when the market was somewhere around about here. I think around about June or July. Now, August, the trend line, the moving average line was violated, but we did get a bounce at the end of August. We then got a strong bounce back in October, got back above that moving average, but since then it's basically gone sideways and then fallen again, to the extent now that you can see that the blue moving average line has now gone flat and has really rolled over. And unless this candle can get back above the blue line by the end of January, then that moving average will have rolled over. The price is spending most of its time now below the moving average. That is the definition of a downtrend. So at a big picture level, these things take quite a time to play out, but at a big picture level, unquestionably the character of the market has changed. Now, whether it's just going to continue to go up and down in a big sideways volatile mess, or whether it goes into a more protracted correction of this whole range, we'll have to see. But I think there's now a substantial probability that we could get a break of this support line. Now, if the market were to retrace the whole bull market from March of 2009, then a very obvious target would be 1578 on the S&P, which is about 15 to 16% below where it currently is. Now that would be a 38.2 Fibonacci retracement of that whole run, which would make sense, and it also corresponds exactly with the 2000 and 2008 peaks. So that would be, if we're going to get a big picture correction, that doesn't make it necessarily a bear market, that would just be a very big picture correction of what we've seen, then they would be a level to look at, and that's a long way down from here. Let's zero in a little bit and look at this period from 2011. So the last decent correction we had was 2011. Let's look at dissecting that period. We'll look at that on a daily chart. So if we look at that chart, and if you can see 2011 had a very similar pattern. We had one leg down in August. We had a bit of a recovery. We had another leg down in September. We then had a recovery to a new high. And then we formed a higher low, and then the bull market resumed. Now this time we had an initial plunge in August. We had a recovery. We had a retest in September. So exactly the same pattern as 2011. We then formed a new high. We went sideways. So up until now, exactly as we saw in 2011. Now, what the last 2 weeks has done has caused a complete breakdown. So we've now, rather than form a higher low indicating strength, we've now gone down and we've retested these lows again. That's the third time in 7 months. It's not a good sign. In fact, it's a really bad sign. Now, critical support. So if we put a Fibonacci retracement range on that run from 2011, we get price targets 1728, 1604. So a 50% retracement would correspond pretty closely with a 38.2% retracement of the bigger range back to the 2009 lows. So there's some possible targets. So if you look at that chart pattern now, the red 150-day moving average line, which is the one that I primarily use to get a fix on how markets are trending, you can see that has now effectively rolled over. It was in uptrend through here, it went flat, and now clearly it's rolling over. And the price now is spending almost all of its time below that moving average. A very small amount of time above the moving average. That in itself is a definition of a downtrend. So I think it's highly likely now that this low will break, this support level, and then if the 2014 lows get taken out, which are at 1820, then we are definitely looking at a much bigger correction. So that's what to keep an eye on. But markets are very oversold in the short term. I think we'll get a bounce this week. No trading on Monday night. It's a holiday in America, but I think we'll get some sort of relief bounce. But how that happens will tell me a great deal about what's coming. Let's look at the Russell 2000. This is on a weekly chart. You can see how the Russell 2000 for small caps is completely broken down now. We've taken out all those lows. We've taken out the 2014 lows last week. So that's not a pretty picture at all. Now, just turning to the VIX, I mentioned before, the VIX has spiked up to 27, as you can see. If we go back here, this is August. So when we got the same move down in the market in stocks, the VIX shot up to 38. This time we've had exactly the same move, yet the market has only gone up to 27. I don't know what to make of that. Interesting, but anyway, we'll see how it plays out. Just while I'm here, we'll look at the ASX 200, just for the record, and it looks pretty poor. You can see very, very clearly in downtrend. If you look at the red moving average line, no question about that. We managed a rally back at the end of 2015. We just touched it, and then we've fallen away quite dramatically. And you can see there's the support line. Support line is now broken. The market will be down further on Monday in Australia. So I'm looking at least below 4600s and possibly further. So nasty outlook in Australia. The Aussie dollar is down to 68 cents. It's clearly broke support at 69.5, and it's now down to the level that it traded at 2009. And the GFC lows at 60 cents are now realistically possible. So I think it's now entirely possible we'll see 60, possibly even a dip into the 50s. The ASX index was down 100 points. August lows broken, and there's going to be a lot more selling on Monday, so it's not immediately going to get any better. Turning to commodities now, gold was lower by $16 for the week despite all the turmoil. Another bad sign for gold. And once again, the gold bulls, the people that are telling you now's the time to buy gold, and there's plenty of them, are wiping egg off their face for about the 27th time in the last 2 or 3 years. I don't know when they're going to stop trying to pick the bottom and wait until we actually get a bottom. There will eventually be one, but it's not inside at the moment. And stocks, gold stocks continue to lead the way. They look awful, and while they look awful, gold's not going anywhere, I can tell you that much. So let's look at the gold chart. This is gold on a weekly chart. Just pan back and give you a bigger picture perspective. There we are. We've got key support at 1,000 or just over 1,000, which picks up these highs back here. We've now broken a long-term trend line, which goes back to 2006. So we've broken below that long-term trend line. We've rallied back up to it, and now we're falling away again. This is this is a downtrend. It's clearly a downtrend. The moving average is heading down. The price of gold is below it. Do not buy into this story that gold has bottomed and is turning up, because it's just too premature. Now let's look at gold stocks. This is the HUI index, which is a good proxy for gold stocks, doing absolutely nothing. No movement there at all. And in fact, poised, looking very much to me like they're going to break down. The index has rallied back to the 150-day moving average and is falling away again. So don't venture into gold stocks, pure and simple. So trade what you see and not what you think, or what you think should be. Wait until gold stocks actually turn around and start looking more positive than gold, and maybe then that might be a point. Copper has completely fallen apart, down to $1.96, broke support, and the big slide in the copper price continues. And all base metals, nickel, tin, they're all under significant pressure. Crude oil also smashed down to 29. We've got Brent crude oil also down to 29. It's been trading at a premium to West Texas Intermediate crude for years and years, but is now at the same level. So it's a horrible picture for crude oil, and still no indication of a bottom. There's the copper chart. You can see broke support at about 208 and is just in a very, very strong downtrend. So just to wrap it up, and I'll just repeat what I wrote last week, because I just think this is such an important message. Focus for a start. Don't panic during these sort of market corrections. Focus on what you can control, and that means having a clear game plan. And hardly anyone ever has a clear game plan. It's what I spend most of my time trying to help people get, and it's not an easy task. That's the best form of risk control. If you've got a clear game plan and you know what you're doing, you know what you're looking for, you know what risks ones you're prepared to take and ones which you're not prepared to take, then that is your best form of risk control, because it helps to eliminate impulsive decisions. If you don't have a clear game plan and the market starts falling, then you're just making impulsive decisions based on, I don't know what. So you've got to have a basis for making those decisions. Now, having said all that, and this is it's been a bit of a doom and gloom video. I understand that. However, I am excited by the opportunities. I'm just painting the picture about how it really is. But I am excited by the opportunities, because volatility creates tremendous opportunities if you know what you're doing. So some bargain hunting from high quality stocks in oversold positions is the next step in the process. And also short selling some weak stocks that should decline. And there's plenty of those around the place that are the businesses are weak, the environment they operate in is weak, their earnings are weak, they've got too much debt, and the prices are going down. So if you know how to short sell, or if you can just buy some inverse ETFs, then I think that's going to be a pretty profitable exercise. Now, what you must know in advance is what you want to buy, and a price structure for how you're going to get in, and a price structure for how you're going to profit from what you're doing. You need to know that in advance. If you don't know it in advance, you won't be able to do it when the market is moving around quickly, because your emotions will get the better of you. So you must know all this in advance. So that's wrapping it up for the week. Members obviously, know they get a lot of support. Every support I can give them. The message really to non-members is This is a really, really dangerous time. It's a terrific opportunity time, but it's a dangerous time if you don't know what you're doing. If you want to take advantage of those opportunities, then for goodness sake, get some help. There's my contact details. You need to be working with someone that's got a lot of experience in the market, that's been through these cycles many, many times before. So that's it for this week. We'll see what next week brings. Cheers.